Okay, continuing in our technical analysis, one of the things we've been looking at are what we call lower studies. MACD and stochastics, they're little indicators that are mathematically derived below price. They're off of the chart, okay? There's a couple of things that we do on the chart. We already looked at moving averages. They're an in-chart study, okay? Another one that we're going to talk about right now are Bollinger Bands. Now, Bollinger Bands were created in the mid-70s by John Bollinger, okay? He's still around. He does an awful lot of lecturing on the different trading circuits and stuff. You'll find him as guest lecturers on CNBC and things like that. Again, he was kind of a beginning of the trading movement. He was still building, this guy, his little ideas here as investment theory, but he was looking for more opportunities. He was looking for higher probabilities. Now, we've talked a little bit about statistical probability in this class. We talked about the coin flip, how in 100 flips it may not come up 50-50. In a million flips it will. That's statistical probability. So what John Bollinger did is he understood that the concept of two standard deviations from the norm would incorporate most of all incidents. Now, I don't want to give you guys a great lecture on statistical probability, but perhaps in your education somewhere you have seen a bell curve. It looks something like that, okay? And the norm is dead center of the curve. Not that I can draw dead center, but that's dead center, all righty? So we could use any sort of a premise to see how it works. And perhaps we say that all of life falls within minus 10 feet to plus 10 feet of average sea level. So that means in the first 10 feet of ocean water, we have what? We have our anchovies, and we have sardines, and we have our plankton. How do you spell plankton? Plankton, very good. And just above sea level, we have what? Do we have ants? Okay, and we got germs. Okay, and of course there's us. Okay, and then there's some giraffes. They're a little taller, aren't they? Aren't they more than 10 feet above sea level? At least their heads are, huh? Okay, and some birds, yeah. Now, everybody, most of animal life falls in this category, right? Along the center line. What then if we went outside of it? Well, if we went deeper in the ocean, wouldn't this be the super deep water fish? The angler fish, those really ugly looking things, okay? And then who lives way up high? You got eagles up in the mountains and some lichen, some different mosses and stuff way up there. But where is most of life? Inside this bell curve, right? So if I started to refine this bell curve, there are certain standard percentages that these statistical analysts use. And again, let me straighten out my center line. One deviation on either side picks up about 68% of those factors we just talked about. If I then go two standard deviations, 1, 2, 1, 2, off of center, okay, well, this will incorporate about 96% of all of our statement. Most of life stays within 10, plus or minus 10 feet of salt water, okay? So now what John did is he took this concept and he turned it on its side, all righty? So what he said was, what if we were to see price moving up and down, and we were to put a moving average on it, and then we were to put another moving average that was two standard deviations away from the center line of price. So he put another moving average over here. So by doing it this way, by using statistical probability, what he is essentially saying is that 96% of all trades will be inside of these bands, that 2% will be above the band, and about 2% will be below the band. But what is the probability of any given trade? Inside the bands. Okay? Now, with this thought process, you see up here we have the Bollinger Bands, and they have a kind of a mustard moving up here. If you look, you'll see it says Bollinger 20. That means the moving average is a 20-period moving average. And 2 stands for 2 standard deviations. Okay? Again, as we saw in some of our other studies, we might want to go in and manipulate this, but let's just work with what we got so far. Okay, so again, if we then had a trade that suddenly went outside of this band, what is the probability that the next trade is going to go higher, or is it statistically more probable that it's going to come back into the band? In the band. Cool. You guys got it. Now, all you have to do is go use it. No, kidding. Now, the neat thing is again, remember, this was designed for longer-term investing / position trading, okay? So it really works great on the bigger stuff. But it can work on short-term. Okay? It's just not quite as accurate. Now, we could also change our terminology just a little bit, and we could say, well, it's improbable that it should be higher than, or we could say it's simply overbought. And if it goes outside of the bands to the high side, then we expect it to come back in. If it goes outside to the low side, then we expect it to come back up. These, where they go outside, and here we see a close above the yellow band up here, and a close in red below the yellow band down here, okay? These are called outliers, okay? In other words, they're exceptional. They're outside the normal parameters. They're outliers. Now, the neat thing is that obviously, if it's oversold, then if we saw a close below, we would think about buying long on the next 1 or 2 candles. Why? Well, again, it's a 20-period moving average. And as Van and I were talking about earlier, okay, these are lagging indicators. So if you guys notice, you see where the yellow line stops on this one. It hasn't shown up on this one yet. So it's at least 1 full candle back, depending on its average and the periodicity of the chart. So we don't know until this line bends through and comes up a little bit whether this is a close below, do we? We can start to guess that it looks likely that it will be, but we don't know until we actually see it. Okay? So when we see a close below the line, and a close below would be a red candle, we're looking to buy on the next green candle or positive move up. Conversely, at the top up here, we can see we have a little bit of an overbought situation, and we see that the green candle is closing outside on top of the yellow line. Now it's overbought, we look to sell off. So we'd like to get short on the next candle or 2. Now, as we've already talked about in getting short, we have a problem because once everybody knows it's a short, it becomes difficult to sell. Ready? So we're really probably hunting for this little green candle right there, because that's buyers. Then it starts to turn into more and more sellers, and sure enough, the thing sells off greatly. Now, personally, and this is my taste, okay, I like to use Bollingers to hunt shorts. I know that fear is a stronger emotion than greed. And therefore, when I see one popping out on the top, I start to salivate more than when I see one going down out on the bottom, already. Generally, the sell-off is a steeper angle down than the buy-up is, in any case. So in any given time frame, I'm likely to make more money with a short than I am with a long. Now, this may be just a little bias. Maybe I look for shorts harder than I look for longs, okay? And you always have to be careful. But, of course, I've at least chosen on the correct side. If you're going to exhibit a bias, at least make it the profitable one. Alrighty, now again, we have to be careful because here we have a 5-minute chart, a couple days long, okay? And you can see that the line hasn't even started over here. Remember, you have to have enough minutes to average, okay? You got to have a long enough period of time. So ultimately, these lines don't just start forever, they start at some point. But we can see that we had a very sharp sell-off, and it looks like we're getting a closed blow right here. So we're going to buy on this candle or the next one, okay? And we're going to hold long. Now, let me give you just a couple of quick rules up here. And again, you can make these as complex as you like, as we talked about with stochastics. It can be K over D and under 80, or you can make it divergence by this angle. You can make it as embellished as you want to. You are, after all, the artist. And this is artistic interpretation, okay? But the first thing I want to do is that I want to open on second or third period after outlier. Why? Okay, again, I need to see the line. Okay, so I'm not going to see the line until posthumously, until it has happened. If I try to second guess, well, it could be, again, if we look in the center right here, we can see we have a red candle right here, and it looks like the line is going to close below the line. But if the next candle gaps down here, then it's still inside the line, and I just went long. Uh-oh. Okay, so you want to have some confirmation. Number two, how do I say this? Trade as long as direction to goal. Well, what is our goal? Our goal is the other side of the line. So as long as the trade continues to move in the direction of my goal, I am happy. But this therefore then brings up number three, our first exit. Okay? And what I use, and again, you can modify it, but to give you a starting point, I use 2 periods away from goal. So if my direction to goal is broken, and in 2 periods I am not moving to